$500 billion vanished in one day as the 2008 crash shattered global markets. While 5 million Americans lost homes, John Paulson made $1.5 billion betting against the crash. But here's what they don't tell you. The crisis was fueled by unchecked greed and ignored warnings from economists like Milton Friedman. Warren Buffett's economic moats strategy and Ray Dalio's all-weather portfolio highlight how the wealthy protect their wealth. Meanwhile, the Federal Reserve's 2008 interventions exposed the invisible power struggles shaping financial destinies. In the 1870s, John D. Rockefeller's Standard Oil used vertical integration to dominate 90% of U.S. net oil production, controlling pipelines, railroads, and refineries. By 1911, the Sherman Antitrust Act forced its breakup into 34 companies, including Exxon and Chevron. Meanwhile, Fannie Mae and Freddie Mac's risky mortgage lending, backed by the U.S. government, led to a $187 billion bailout after their collapse in 2008. Friedman's warnings about inflation in A Monetary History of the United States, YX, The Road to Serfdom, 1944, warned of central planning's failures, yet regulators allowed banks to gamble with derivatives worth $600 trillion in 2007. The rich didn't just predict the crash, they built systems to profit from it. As the Fed printed trillions in 2008, Buffett quietly bought banks at fire sale prices, while Dalio's Bridgewater Fund hedged against debt-driven bubbles. The game wasn't fair, but the players knew the rules. The first hidden rule of wealth is compounding interest, a snowball rolling downhill, gathering speed and size with every passing year. In 1920, a $10,000 investment in a 7% annual return would grow to $280,000 by 1940, but if left untouched until 2020, it would balloon to over $14 million. Yet most people stash money in savings accounts where rates hover near zero. In 2023, the average savings account yielded just 0.5%, while the S&P 500 returned 11.3%. The gap is not just numbers, it's a lifeline. A 25-year-old investing $300 monthly at 8% would amass $3.7 million by 65 versus $144,000 in savings. The rich don't just save, they let money work for them. Diversification is the second rule, a shield against ruin. In 2000, Microsoft stock cratered 75% during the dot-com crash, but investors who balanced portfolios with gold, treasury bonds, and real estate lost only 20%. The 2008 crisis saw similar patterns. Those holding 60% stocks and 40% bonds lost 30%, while all stock portfolios fell 50%. In 1929, the crash wiped out 89% of stockholders' wealth, but those holding U.S. Treasury bonds saw their value rise 40% by 1932. Diversification isn't just spreadsheets, it's survival. Tax efficiency is the third rule, a silent multiplier. Warren Buffett's use of municipal bonds, which are tax-exempt, saved him $300,000 annually in federal taxes. In 1981, when the top tax rate was 70%, Buffett's Berkshire Hathaway avoided paying taxes on municipal bond income entirely. Today, high-net-worth individuals use offshore accounts, Roth IRAs, and tax loss harvesting to minimize liabilities. The middle class pays 24% in taxes on investments. The rich pay less than 15%. The gap isn't just legal, it's engineered. Wealth isn't just earned, it's protected. Lehman Brothers' 2008 bankruptcy triggered a $1.3 trillion collapse in global markets within a week, wiping out 40% of the S&P 500's value. But the ripple effects didn't stop there. AJ's $182 billion insurance failure forced the Fed to inject $150 billion in emergency loans, while Bear Stearns' $50 billion stock collapse led to a $30 billion bailout. Ordinary Americans watched their 401(k)s vanish as the Dow Jones Industrial Average plummeted 50% from its 2007 peak. Meanwhile, billionaire Warren Buffett quietly bought $10 billion in Goldman Sachs stock at 50% below its 2007 value, turning the crisis into a windfall. The Nixon shock of 1971, when the U.S. abandoned the gold standard, sent inflation soaring from 4% to 12% in 1972. A family earning $10,000 in 1970 saw their purchasing power drop to $1,700 by 1980, as the dollar's value halved. In Weimar Germany, 1923 hyperinflation turned a loaf of bread from 1,000 marks in 1922 to 100 billion marks by 1923, erasing savings for 90% of Germans. A teacher's salary, once enough for a month's rent, now bought 100 loaves of bread in a single day. The 2022 crypto crash mirrored these collapses. Terra's $40 billion ecosystem imploded in 48 hours, wiping out $60 billion in market value and leaving retail investors like 24-year-old Alex Chen with a $200,000 loss in a single week. Unlike 2008, there was no Fed bailout, only a $30 billion rescue for Celsius Networks, while millions of retail traders watched their savings vanish. But what investigators discovered next changed everything. The 2008 crisis wasn't just a failure of regulation. It was a systemic breakdown in risk oversight, with banks holding $600 trillion in derivatives unaccounted for in 2007. The same institutions that bailed out Wall Street in 2008 later lobbied to weaken Dodd-Frank reforms, ensuring future crises would be even harder to contain. The domino effect wasn't just financial. It was political, legal, and existential. The rich don't just save, they invest, hedge, and outmaneuver systemic risks. Consider the case of Sarah, a teacher who began investing $200 monthly into an S&P 500 index fund at age 25. By 65, her portfolio grew to $1.2 million, while her brother, who waited until 35 to start, had only $240,000. The difference, a mere 10 years but compounding, turned $48,000 into a seven-fold return. This isn't luck, it's math. The wealthy understand that time is their most valuable asset. If the 2008 crisis taught us anything, it's that central banks can't prevent bubbles. Can you? In 2021, crypto billionaire Sam Bankman-Fried's FTX collapsed, wiping out $30 billion in customer funds. Yet, unlike the 2008 crash, there was no Fed bailout. Why? Because the system had changed. Regulators, fearing political backlash, allowed crypto to operate in a regulatory gray zone. The lesson: bubbles don't just burst. They're engineered by those who ignore history. Keynes' animal spirits theory, 1919, explains why markets crash when fear overtakes rationality. In 2020, as the pandemic hit, the S&P 500 fell 34% in a month, but those who bought during the panic saw a 150% rebound by 2022. The rich don't panic. They bet against fear. Ray Dalio's all-weather portfolio, which allocates assets across stocks, bonds, commodities, and currencies, lost only 5% during the 2008 crisis, while the S&P 500 dropped 50%. Money talks, but only if you understand the language. Subscribe for more stories behind the economy. Tell us, did you see this coming? The next time a market trembles, will you be the one betting on recovery or the one watching your savings vanish? The gap between wealth and poverty isn't just about income. It's about knowing when to act, when to wait, and how to let money work for you, not against you. The rich don't just predict the future, they build systems to survive it. Will you? The pattern interrupt wasn't just about John Paulson's $1.5 billion windfall. It was a symptom of a deeper truth. The rich don't just predict crises, they weaponize them. When regulators ignored Milton Friedman's warnings about the housing bubble's fragility, they handed millionaires a blueprint for profit. Paulson's bet wasn't luck, it was leverage. He shorted mortgage-backed securities while the Fed kept interest rates near zero, inflating a bubble that would burst in 2008. The same system that let Lehman Brothers collapse also let Buffett buy Goldman Sachs at fire sale prices, turning disaster into opportunity. The final lesson isn't just about investing, it's about power. The wealthy don't just manage money, they shape the rules. When Fannie Mae and Freddie Mac collapsed, the government bailed them out with $187 billion, while millions lost homes. When crypto's $40 billion Terra ecosystem imploded, there was no Fed rescue, only a $30 billion lifeline for Celsius. The rich know the system's blind spots. They diversify across assets, hedge against inflation with gold and real estate, and use tax loopholes to shield wealth. The gap between the top 10% of Americans, who hold 70% of global wealth, and the bottom 50%, who own just 1%, isn't accidental, it's engineered. The same forces that let Paulson profit from 2008 are still at work today. The question isn't whether you'll see the next crisis coming, it's whether you'll be ready to act. The rich don't just save, they outmaneuver. Will You Money talks, but only if you understand the language. Subscribe for more stories behind the economy. Tell us, did you see this coming? The next time a market trembles, will you be the one betting on recovery or the one watching your savings vanish? The gap between wealth and poverty isn't just about income. It's about knowing when to act, when to wait, and how to let money work for you, not against you. The rich don't just predict the future, they build systems to survive it. Will you?